Hey everyone, welcome to our newest episode of St. Robert Finance's podcast, Cash Chronicles.
Good morning. My name is Ken.
Hey, my name is Sarina.
And my name is Ryan.
So, today we'll be talking about something slightly different from what we usually do.
Behavioral finance. So, folks, today we'll be talking about behavioral finance. We are going to explore how psychology influences our investment decisions and how understanding these behaviors can help us make better financial choices.
Wow, great comment, Ken. So, I think before we get into all of this, let's start off with answering the question, what is behavioral finance? So, firstly, instead of traditional finance, which focuses mainly on the logistics and pure financial aspects of such, behavioral finance is a field that blends finance with psychology, and it focuses on understanding how psychological factors impact financial decisions. So, imagine you're investing in the stock market, line goes up, money goes up, it's really consistent. But there is a reason why a lot of people make slightly irrational decisions, and that is a field of study that we're going under called behavioral finance.
Awesome. So there's actually sort of a contrast between two different types of ways people behave. There's traditional finance and then there's behavioral finance. So let's talk about traditional finance first. That's where we assume that everyone or like all investors are going to act rationally. They're going to be logical. They're going to make decisions based on the information they have. So they're going to just whatever information they receive, they're going to make the best decisions they think they can with that, and that maximizes the amount of money they can make. But the thing is, people don't do that, and that's what behavioral finance is. It acknowledges that oftentimes investors act irrationally because they have so many things just about the human condition that change that. So there's things like cognitive biases, emotions, mental shortcuts, etc. And all of these together influence investors' choices and decisions way beyond just the information they are given, which leads them to deviate from rational behavior.
Okay, so now let's look at some of the core concepts in behavioral finance. And there's quite a few of these. So, first one is heuristics. And these are basically mental shortcuts that help us make quick decisions. And while helpful, they can lead to biases like availability bias. And I think a great example of this is basically you go to a restaurant, a restaurant you often go to, right? And you keep ordering the same dish because you know it's familiar. And essentially, what that basically means is that yeah, you chose something, sure, but you didn't necessarily evaluate all the other options that might have been on the table. Something else could be the prospect theory, which basically suggests that people treat gains and losses differently, and it leads them to avoid losses more strongly than pursuing its equivalent gains. But just remember, guys, it's better to buy low, sell high than to buy high, sell low. You should never be looking at, is this company down or up? You should be looking at, is this company fairly valued? Is this company, in a good financial situation? So that's why it's important to read the balance sheets. Third one is probably overconfidence bias because investors really, really often like to overestimate their abilities or knowledge about the market, especially if they had, maybe I'm not going to say they got lucky, but maybe, they had a very good return once a while back. Maybe they think, oh, IB students, we often overestimate how long we can finish writing a paper. And then, we're forced to pull an all-nighter when we realize, wait a second, this takes a lot longer than I thought it would be. Anchoring. We tend to rely on the first piece of information that we receive, even if it's not necessarily relevant. A good example of this is that when you shop for a new phone, right? The salesperson, when you shop for anything, the salesperson is going to show you the most expensive thing first. And in doing so, they essentially anchor you to that higher price point and make every single thing that comes right after seem a lot more reasonably priced, even if it's still expensive. I remember when I was going to buy my first suit, right? I went to the suit shop, right? And they showed me this Hugo Boss suit. It was like $1,000. And I was like, wow, is there anything else? And then they took me to the other side of the room. They showed me this, I think Calvin Klein suit. It was like $500. And it's like, wow, that seems a lot more reasonable, even though $500 per suit is still actually a bit too much money for a
Yeah.
suit, if you will.
Right.
So yeah.
Wow, that's a lot of money, honestly. Clothing seems so
And it
expensive
is, no.
nowadays.
You have to buy suits on sale. You can't buy it full price. Don't ever do that. Don't
Mm.
ever do that.
Like tailoring's gotta be expensive though.
Yeah. Take it.
So anyway, let's move on to more cognitive biases. In contrast to the general concepts which Ken so helpfully discussed earlier, this time we're on cognitive biases, we're going to be focusing more about specific issues that might affect you in finance rather than generally in life, although these are all good things to know. So first of all, let's start about talking about confirmation bias. Confirmation bias is probably the most common that affects investors because it happens when investors only seek information that supports their existing beliefs. Let's say that I believe that this company is going to do well in, for example, the next quarter. And so I seek out information relating to this company. But because I already have a predetermined belief or confidence that this company is going to do a lot better than it did in second quarter, I will have a tendency to seek out sources confirming this belief instead of denying it. Secondly, herd mentality. Herd mentality is when people follow the crowd and think that others know more or are making the right decisions. This happens a lot of time in investment bubbles. For example, when a lot of people invest in a certain area, a lot of other people follow seeing the success of the previous successors and therefore believing that they might achieve that a similar level of success as well. But this isn't always the case. Oftentimes, the first people to go into a field are the ones who end up the most wealthiest, and everyone else is kind of just going for it. Thirdly, let's talk about framing effect. The framing effect shows that how the way information is presented can significantly impact how decisions are made in general. For example, I think we hear this all a lot of times in colloquialisms. For example, if we say, let's frame it in a better way, then that often shows that we're painting a different point of view from how this situation is really. I think a good example of the framing effect is an example of the framing effect might happen when someone says that there's a 90% chance of gains on a particular investment instead of a 10% chance of losses. And finally, let's move on to mental accounting. Mental accounting happens when people treat money differently depending on where it comes from or how it's intended to be used. Let's say you file your tax returns and you file that money wrong. And instead of you paying the government pays you the extra money that you accidentally overpaid them. Instead of, for example, treating that money as money that you could have used for normal expenses, a lot of people have a tendency to use that extra money that the government has given back to them for tax returns, seeing it as a gift for the government rather than their own money that should apply to the same rules and regulations as it usually does, because in their mind, that money has already been accounted for. Well, all of
Awesome.
it,
Oh,
And just before anything further, please do not fake your tax returns because the government does and can and does, audit those returns. And when they find out that you're not eligible for that, they're going to find you and they're going to ask for the money back. So put it this way. Um, if you were if let's say you're the player at the casino and the government is the house. The house always wins. Don't don't fake taxes. You can't ever avoid a tax man, guys. Just remember that.
yeah, wasn't there something like the three inevitabilities of life are birth, death, and taxes?
Yep. Two things you can't avoid in life: death and
yeah, death and
taxes.
taxes, right?
Death and taxes.
Question that you guys are probably now wondering is like, so what, right? Like, why does it matter? Everyone probably has a little bit of behavioral finance or behavioral bias. Why do we care? Well, the thing is that with these different behavioral biases in finance, we can cause so many inefficiencies in the market, and has historically that has caused so many crazy um, so many crazy problems and crises. So few examples of this is behavioral. You could say to a pretty reasonable extent that behavioral biases and behavioral like finance was responsible for the Great Depression in the 1930s. It was responsible for the dot-com bubble, the 2008 financial crisis. All of these crises that we see, a lot of it is because of the behaviors that people have when they invest in the stock market. Okay. The thing is that because investors often react based on their emotions, not based on information or pure numbers, people will overreact or underreact to different types of news. And that can really cause a lot of really large swings. Or if if people underreact and they don't really mind a problem that is larger than it, that is smaller than it should be, that is actually larger than what it seems. You can sort of build this secret problem that compounds over time and leads to these big depressions and these crises. And so Ken will actually tell you a little bit more about these examples and how they actually happen.
Yeah, so that's good. That's actually a good note to talk about some real world examples. Thank you, Ryan. So, like Ryan mentioned, there was the dot-com bubble of between like 1999 and 2000, which basically saw, I guess we could call it herd mentality over internet stocks. People essentially just, kept buying, 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 and investors kept pushing prices far beyond what they actually were worth. So the end result, as all things, as all bubbles do, bubbles pop, and there was a big market correction, and a lot of companies went bankrupt. And then, even companies like Amazon, Cisco, right? They barely survived. Like Cisco lost like 80% of its market value, right? And we see this again with the 2008 financial crisis, right? There's just so much um overconfidence and excessive risk taking in the market, and it led to absolutely disastrous financial outcomes. The banks, they did not keep enough liquidity, and they kept buying bad, mortgage-backed securities portfolios. And what that basically means is that, say you have a mortgage, you get a mortgage from someone, right? They can sell that mortgage off to someone else, and that's that. But whatever they bought, whatever investments the banks bought, they had very high rates of delinquency, which basically meant that people didn't pay their mortgages on time, because banks before 2008 used to give out mortgages like, trick-or-treating on Halloween. It was absolutely, absolutely awful. So again, we see herd mentality there. And even today, right? Cryptocurrency. I think this is a great one. We often see a lot of fear of missing out, FOMO, and that drives investors to make very impulsive and very speculative investments. And it also leads to people taking, advantage of other people. We have pump and dump schemes where, on social media, people say like, "Oh, buy this cryptocurrency, it's amazing," and then people buy it, they raise the price high, and then someone sells off and just run away with all the money, and then everyone's left, looking like dopes. And even to some extent, Tesla, right? If you look at Tesla's price right now,
Oh,
Tesla stock is,
it's crazy.
yeah, it's crazy. Like Tesla stock right now is like, I think 240.68. The 12, okay, I'll tell you what, the 52-week high was 488.54. It's still in US dollars. So you're telling me basically Tesla lost, yeah, basically 50% of its 53% of its, market value in not even 3 months. Well, granted, most of this was after the new presidency, but seriously, guys.
Yeah.
And if you look at their and this is why I keep saying, right, don't buy companies based on the fact that everyone else is buying them. You have to look at the performance metrics set by the company publishes. Like for example, price to earning ratio, right? The average PE ratio is like what, 20, 25? Tesla's right now is 118. That should tell you more than, that should tell you all you need to know. So yeah, be careful out there, because there are bad people and there are people that will, take advantage. Herd mentality sucks. Look at GameStop. Look at all those meme stocks, meme coins out there.
Thanks, Jen. That was a really good example of some of the potential applications of behavioral finance in the investment field in the investment field generally. And I think other than that, there are also a couple of ways that we can use our knowledge of behavioral finance to improve our knowledge of more solid finance holistically. So how can we overcome the biases that we've talked about earlier? So a couple of strategies. First of all, self-awareness. The first step to recognizing when biases are influenced. Oops. Thanks, Ryan.
Very good. Keep going.
Okay, yeah, sure. Thanks. The first step is recognizing when biases are influencing our decisions. Second of all is systematic decision making. One should aim to create rules and procedures to guide decisions, which can help avoid emotional and irrational decision making by making sure there's a due process in order for any mistakes or irrational decisions to be caught before they have further impact. Thirdly is diversification to avoid the herd mentality and only invest in avoid only investing a couple of investments that a lot of people are choosing to go for. One should aim to spread out investments over a variety of assets. For example, instead of sticking only to cryptocurrency or sticking only to Tesla, we should aim to spread our investments across many different fields from perhaps larger corporations such as the tech industry to perhaps even industries that most people don't consider in their daily life, like steel manufacturing for some people. And finally, in order to avoid making a lot of mistakes that one might not catch on to, it's always good to have a different perspective when it comes to your investments. You can always choose to consult with financial professionals to gain a more objective perspective and avoid impulsive decisions. So I think there are also a lot practical applications of behavioral finance when it comes to the business sector. Ryan, do you want to talk about that?
Yeah, so just to quickly recap, like in personal finance, like if you're trying to do things like invest in stocks or assets for yourself, you have to understand how your own biases can change the way that you might react to certain purchases or certain news, right? You have to understand where you go wrong in your emotions, and that can make you understand, or at least if you are aware of the problem, right? Like that's the first step in solving it. So we just want you to understand your own biases so you can make more rational choices about all these different things. Now, for corporate finance, understanding these biases can really help prevent bad decisions, really bad decisions, like if there were, or it can prevent bad decisions in areas like mergers and acquisitions or financial planning. Just overall, that's probably pretty good. Financial advisors can also use behavioral finance principles to better understand how clients behave and provide better advice, which is kind of what we were talking about from a consumer perspective. If you want to avoid your biases, you should seek advice from advisors. And that's about it. Just to quickly conclude, behavioral finance, it provides all these really, really valuable insights into how we as humans think about investments, because we don't just think about them through numbers and logically. If we are able to understand these behaviors, we can just make better decisions that are more rational, because when we're talking about investments, rationality is usually the thing that gets you to the best place. The only issue is that no one is ever that rational, right? So just recognizing these biases and these behaviors that we face is really, really key to minimizing the impact that we might have on ourselves and get better financial incomes. Not incomes, better financial outcomes. Does anyone else, like Ken, Sarina, you guys want to add anything? I'm happy to talk about this for a bit longer.
Sure. And I think those are also some really important points that you've brought up, Ryan. And I particularly agree about your point on ensuring better financial outcomes, because the point of behavioral finance, it's still it's still a bit like branch of finance as a whole, but it also has some aspects of psychology that a lot of people aren't willing to encounter in their day-to-day lives despite this importance. And through this discussion we've had right now, we hope to impart some of that urgency and some of that importance of this topic to impart the fact that finance isn't all logical, as I think both Ken and Ryan have said a lot. One
Right.
should be aware of your own biases, even if you believe you don't have any, because everyone always has some biases that they've accumulated over the course of their lives. And it's important to realize that so that you can make the best financial decision using the most unbiased source information you can.
Well, awesome. Thank you for that, Sarina.
Yeah, absolutely.
Does anyone else have anything to add on?
Maybe we have to edit that out. I'll say something. Yeah, that's a good point that you guys make, Ryan and Serena. I think people sometimes are inherently impulsive, and companies know, and they do indeed take advantage of that. And I think the best way I'll put it is if you go to any store, right before the checkout line, they always put all the candy bars, all the sweets, all that stuff at the very front. That's to tempt you to buy something else on the way out. Like I think it was research that said half of purchases that you make are impulsive. And you know what? Yeah, sounds about right. I could see that happening. All right, folks, thank you for tuning into episode 6 of SCR Finance's podcast, Cash Chronicles. My name is Ken,
My name is Sarina.
And my name is Ryan.
and we'll see you next time.